I share a lot about the local housing market, but it's also important to keep an eye on national real estate trends and where the country is headed.
So one of the things that we're going to talk about right from the beginning here is a very good possibility that we're going to have a recession in the next 18 months. We have to realize with the Democratic debate starting and with the economy doing as well as it is, and there being question marks about whether the economy will still do well. For example, the Fed just lowered the interest rate because there were some concerns in their mind. I think we're going to see more and more or hear more and more talk about, is the economy faltering? And I think that the word recession is going to keep on coming up. So I wanted you to be prepared for it and show you just some statistics and things that we've gathered to be able to kind of let you know how that has to do with the housing market. So some of these things I'm going to skip over pretty quickly, but you can always pause and look at the graph if you want to look at it in more detail. So with the 4 surveys that we have here, the main takeaway is that 67%, so 2 out of 3 of all the people surveyed, said that they're going to come across a recession between now and the end of next year. And let's not forget what next year is. It's the presidential election year, so probably the most contested presidential election in our nation's history. So there's going to be a lot of animosity being served up by both sides, I think. And there's going to be a lot of questions over the economy and why is it good and is it about to come apart? That's going to be a part of the political speak for sure. Now, I don't think that we're going to have the same results of 2008 because it's not the same situation as 2008. But I do want to point out 2 different quotes from last year when they did a study and looked back on 2008. The 10-year anniversary of the crash of 2008. They looked back at it and they said, what were the major challenges that happened in 2008 to cause the whole economy to crash, the worldwide economy to come to its knees? So first of all, Ben Bernanke said last year, my results do suggest that in the absence of the panic, the declines in employment, consumption, and output at the early stages of the Great Recession would have been significantly less severe. So Ben Bernanke is saying if people didn't panic, 2008 would have been nowhere near as bad as it actually wound up being. And the second quote I have is from Warren Buffett in 2018 Wall Street Journal interview, again looking back at 2008, 10 years later. And his quote is, fear spread like a tsunami in 2008. So what are we saying? Well, the word recession is going to come up. I just don't want, and nobody in the real estate industry wants you to equate the word recession to a housing crisis. Remember, in the last recession, prices dropped 19.7%. But if we look at the 4 previous recessions, 3 of the 4 times prices went up. 2 of those 3 times they went up almost double the normal historical average. And the other time that it dropped, they dropped by less than 2%. So the fear that 2008 is going to happen all over again because the word recession is applied. But if we look at the most current survey that was done just a couple weeks ago, it was from Pulsomic's survey of analysts, and they asked them, when will the next U.S. recession begin? And on that, just that one survey, 59%, 9% in 2019, 50% in 2020, said that it's going to happen in the next 18 months. So what we're looking at is a 59% said, yes, the recession is coming. But what wasn't reported in the news is that same day on the same survey to those same exact analysts, they asked other questions. And one question was, what was going to trigger the next recession? And here are the top 3 answers. The top 3 triggers, according to that same exact survey that projected a recession was coming, this is what they said. Number 1 trigger is probably going to be trade policy. Number 2, there could be a stock market correction. And number 3, geopolitical crisis. when they looked for a housing slowdown, because that did come up, some people did pick that. That was all the way down at number 9. So there were 8 things that were going to happen that were going to trigger the recession before they even got to a housing slowdown. So again, in 2008, the housing slowdown, the situation in the mortgage industry caused that recession. This year, we're not even in the top 8 reasons that a recession might take place. Again, those same people that same day on the same survey also projected where prices are going to be over the next 5 years. And as we can see, they think this year they're going to finish up with a 4.1% appreciation. That appreciation is going to slow up over the next couple of years, and then it's going to come back and recover to a normal historical appreciations, which is somewhere between 3.5% to 4% on an annual basis. So the most important thing is the same people that projected the recession was coming also said prices are not going to depreciate. So appreciation is going to decelerate, but prices are still going to go up. So the crash that we saw in 2008, the people actually predicting the recession are saying we're not going to see that again. All we're going to see is a slowdown in the amount or the percentage that homes are going up, not that they are going to be depreciating. And I talked about this on my end of the year wrap up that I did. Same thing, that because we have already been seeing that in our Dallas, Plano area market. And we were going up and up, and then we just kind of hit a plateau, and so people were thinking, oh, everything's slowing down and it's depreciating. No, it wasn't going up at such enormous numbers like it was, in the previous couple of years. So, and even Morgan Housel, a well-renowned financial analyst, I like what he says. He says, an interesting thing is the widespread assumption that the next recession will be as bad as 2008. Natural to think that way, but statistically highly unlikely. Could be over before you realize it even began. Let's hope that. So, putting recession talk aside, let's talk about buying some houses. So, there was a recent survey done by CoreLogic that showed that affordability is in people's minds was a leading obstacle to homeownership. It's no longer down payment. It's no longer all those other things. The number one obstacle to home ownership by the survey was affordability. And that number jumped dramatically from 2018 to 2019. It went from a little over 30% all the way up to 40%. And it's, again, the number one obstacle in buyers' minds. So I get that people are talking about affordability. I get that people are saying, well, affordability is not where it was 10 years ago. But we have to remember 10 years ago, interest rates right after the housing bust dropped to all-time lows and prices dropped dramatically. So very obviously affordability then was better than it is now. If we take a look at affordability going all the way back to when the National Association of Realtors first started recording it, we can see that if we go back to 1990 and we look at today's affordability, and by the way, guys, that graph, the higher the graph, the more affordable homes are. We can see that today's affordability index is nowhere near where it was the years when distressed properties dominated the market, the red bars. But if we go before that, if we go to 2007, 2008, all the way back to 1990, it's more affordable today to buy a home than it was in the 1990s and all through the 2000s, right up until the crash. So yes, it's not as affordable as when the houses were cheapest in some ways in American history, but it is more affordable than the normal markets that preceded the boom and the crash. If we look here at this graph, the CoreLogic came out with their typical mortgage payment, and they said that the typical mortgage payment adjusted for inflation that buyers commit to now, and they take a look at it from January 2000, and then they look at it in June 2006 at the height of the boom. They look at it in February 2012 at the bottom of the crash. Sorry, my dog Addie's just having a good old time over there barking at car driving by or something silly. But anyway, so they looked at the February 2012 at the bottom of the crash as well, and what has been since then, and what they projected to be March of 2020. And what we can see is a typical mortgage payment, though above where it was in February 2012 at the bottom of the crash, is better not only than what it was during the height of the boom, but it was better than what it was prior to the boom in January 2000. Adjusted for inflation, today's typical mortgage payment is less than it was then. And what is projected to be this time next year, or March of next year, is still slower than what it was in January of 2000. And part of the reason for that is, wages are going up, and interest rates, though not where they were in 2012, are still lower. So another thing that the National Association of Realtors does is they list every month the payment, typical mortgage payment, as a percentage of income. And then we can see that since June of last year, for the last 12 months, it's been falling, and now it's jumping somewhere between 16 and 16.75%, but a drop from 18.2%. But probably the best thing about that historically, before the boom and the bust, and what's happening since historically, the percentage of your income that goes to a house, a mortgage payment, was 21.2%. So that 16.6% today were much lower than what the historic norm was. So I just want to make sure that you guys understand, if you're looking that prices continue to go up and you start saying, well, if prices are going up, then it's going to be less affordable. Well, no. As Mark Fleming, First American's chief economist, explained, when demand increases for a scarce, limited, or low supply good, prices will rise faster. The difference between houses and other goods is that we buy them with a mortgage. We buy homes with a mortgage. So it's not the actual price that matters, but the price relative to the purchasing power. Meaning, when we put in wages, when we put in the mortgage rate, and we put in the price, what percentage of the amount of money that you make goes to your mortgage payment. And as we have just shown you, the number has dropped dramatically, and it's much lower than the historic norm. And the reason for that is that 30-year fixed rate mortgages, the rates have dropped almost a full point in the last 8 months, from 4.75% to 3.75%. So, when you talk to your lender and they're wanting to know all your, debt and what your monthly payments are and all that to get your debt to income, because they're wanting you to stay under a certain percentage that you put towards your mortgage. And if you want to buy a bigger house and you want to put 50%, of your monthly income towards it, they're going to say no, you're not going to get the loan. So, but going back to Mark Fleming, the chief economist at First American, here's an interesting tidbit. If the 30-year fixed rate mortgage declines just a fraction more, and some people are projecting that to happen, consumer house buying power could reach its highest level in almost 20 years. So not only is affordability not a challenge, now there are certain markets where prices are way up. Not only is affordability not a challenge, it might be the best it's been in 20 years if the interest rates just drop a little bit more, and that's big. So I am going to play for you next my Plano area, what's happened over the last month in your local market. If you're not in the Plano area, just follow that link and it will take you. I've got several other ones because I am a realtor, in case I didn't say that before. I'm a realtor in the Plano, DFW area, do Plano, McKinney, Frisco, Allen. So if you're looking to buy a house, or if you have one to sell, then please give me a call. You can just go to my website. It's TeamDuffy.com or askforduffy.com. So I'm going to play the Plano section next, and feel free to read the blog underneath that goes into more details, and it also lists a lot of the sources that we mention in that blog, and all the graphs that I've shown you today. Or I'm going to have it up in just a minute, and I'm going to pause it and let you kind of look through if you want to look anything else up.
And with the low mortgage rates, if you're thinking about trading up, click below to read our latest blog post for more information, or just call me to schedule a free consultation. 817-4-DUFFY-4, or go online to askforduffy.com. Happy house hunting.
Market update. Let's take a look at residential real estate activity in your area during the month of July. The number of active listings was down 3% from 1 year earlier and down 3% from the previous month. As you can see, the median listing price for the month was just over $420,000. Compared to last year, the average number of days units spent on the market before being sold was up 31%. This higher number of days may signal a slowdown in the local inventory turnover rate. The median sale price was just over $370,000. The number of units sold decreased 22% year over year and decreased 33% month over month. Fewer sales could indicate an opportunity for buyers to negotiate better terms. Thanks for watching. We hope you found this video helpful as you gather more information to make smart, informed real estate decisions. If you'd like more
You
information,
can also follow the link to TeamDuffy.com to get status updates on all properties, see staging photos before and after, and don't forget to stop by the Your Neighborhood page where you can get sold prices, sold dates, and photos of any property within a subdivision. You can also get a CMA sent to you within 1 minute. I hope you have a fantastic rest of your day and